you're looking to get into Forex trading, then this is the only video you'll need to start. From how Forex works to how to place trades and how you can even get access to $100,000 or more of capital without ever risking your own money. I've been trading almost 8 years and it took me about half of that time to actually get profitable. And the whole point of this video is to try help you get to profitability way faster than it took me and faster than it takes most new traders to get to profitability. By the end of this video, you'll be ready to take your first trade with confidence. So let's go. So first, let's start by looking at exactly what Forex is. Forex is the shortened version of foreign exchange market, which is the global market for exchanging currencies, where you're essentially trading one against the other. Now, the Forex market is the largest of all the markets, and it trades an incredible volume of around $7.5 trillion a day, which towers above all of the other markets. The Forex market is also open 24 hours a day, 5 days a week, which means from Monday to Friday, you can trade whenever you want. But I wouldn't suggest you trade whenever you want. You got to make sure you're trading in the higher volume times, and we will be talking about that later. So think of it like this. For example, if you're traveling from the States to Europe, you're going with your dollars, but you need euros while you're there on holiday. So you exchange your dollars for euros. And by doing so, you're actually participating in the Forex market. Now, these exchange rates will change based on supply and demand, just like stock prices do. And there are also other factors that will affect the market too. For example, news events, things that are happening around the world can also affect the market. Now, you as a trader can profit by predicting a move in a certain direction. And if you get that right, you can actually make money from doing so. So now let's go and talk about how Forex trading actually works. Forex is always traded in currency pairs. For example, Euro USD, which would be the Euro traded against the US dollar. And if the Euro USD goes up, it obviously means that the Euro is getting stronger against the USD, or the USD is getting weaker against the Euro. And vice versa, if Euro USD goes down, then the Euro is getting weaker or the US dollar is getting stronger. Now you get three different types of currency pairs. The first one being the major pairs, which are the most popular and the most traded and often hold the most liquidity. So as you can see here on TradingView, I've clicked on the major pairs, and these, as it says, these are based on popular currencies that are paired with USD. So these will always have USD as one of the pair. Then the next one you would have is the minors, which would be pairs that are not associated with the USD. For example, Euro British pounds, Euro Australian dollar, British pound Euro, British pound Japanese yen, and all of these are all minors, but they're not quite as popular as the major pairs. And then finally, we have the exotic pairs. Exotic currencies represent currencies of both developing countries as well as specific few developed countries. For example, US dollar, Brazilian real, US dollar, Czech krona, US dollar, Hong Kong dollar, US dollar, Mexican peso, US dollar, South African rand. So all of these are exotic pairs, and I would say they are less popular to trade. They are not quite as liquid and don't move quite as much or have as much volume as the major and the minor pairs. So next up, we're going to actually look at how you can make money from these pairs. Now, essentially, you will make money when you make a prediction that price will move in a certain direction and price does move in that direction. And the key concept to understand here is number one, pips, and also lot sizes. So these two come hand in hand. And what is a pip? So let's jump over to the chart so I can show you this in more detail. So when you're looking at a pair, you will normally see that there is 4 digits. In some cases, there's 3, and in some cases, there's 2. For example, GBP, JPY, you can see there's 2. Now, if you're looking on the side here, you'll see 5, but normally the number that you see is going to be 4, and the smaller number there is a 1/10 of the pip. But the 4th digit after the decimal, for example, on the Euro USD, let's have a look over here. You can see 1.0936. So the 6 over here represents a pip, a single pip. So if this now goes to 1.0937, it means the price has moved up by 1 pip, okay? And then, for example, the NAS or the XAUSD or any of these, you're looking at the second. For example, GBP JPY, it's the second number after the decimal. That is what's representing your pip, okay? So it's normally the last digit that they show. Don't look at these smaller digits because this is a 1/10 of a pip. You're looking at the main number, the 4th main number after the decimal place. That represents a pip. Now, the next thing to talk about is your lot sizes is essentially how much you're going to be risking, and that will mean 1 pip based on the lot size changes the value that you will be going up or down. Okay, so let's jump over to the chart again to show you this. So normally you would be trading either micro lots, mini lots, or standard lots. So let's have a look at these. A micro lot would be worth 0.01 of a full lot, and this would represent 10 cents per pip movement. So every time you move 1 pip, you'll make or lose 10 cents. A mini lot is 0.1, which means you would make or lose $1 for every pip that moves. And then a standard lot would be worth $10 per pip. So for example, if Euro USD moves 50 pips and you're trading one standard lot, which is worth $10 per pip, 50 pip movement would make or lose you $500. So I hope that makes sense. I hope you're starting to get an understanding of how the market moves, how you're actually making money, and how the next step is also very important. And with that being said, let's jump straight over to that next step, which is how to actually place your trade on the chart. Now, there's 3 simple steps that you need to follow in order to place a trade on your chart. The first is obviously you need to pick your currency pair. Now, for a beginner trader, I would always say try not to trade too many pairs. If you can only look at 1 or 2 pairs and get used to those, you start learning how that market works. You get an understanding of how it moves, why it moves, when it moves, and you get a deeper understanding of that market. You get a feel for that market. So trade 1 or 2 pairs only. Don't overtrade the markets. The next step you're looking at is you've got to choose 3 different types of trades, and I'm going to show you that when we go over to the chart. And then your third step is risk control. You need to sort out your risk management for that trade. So with that being said, let's jump over to the chart so I can show you this. Okay, so here we are on the chart, and this is actually a replay tool because it'll be the easiest way for me to show you how to actually place a trade and you can see it play out. So like I said, firstly, we're picking our pair. So I'm on Euro USD, and that's the pair that I like to trade, that and gold, but I don't really overtrade. I don't trade too many other pairs. I look always at Euro USD. That's my kind of main pair, but you pick what works for you, right? So we've picked our pair. So the next thing is we need to pick our trade type. Now there's 3 different types of trades that you can place on a chart. First off, you have market execution, and that is essentially entering a trade exactly where price is. So entering straight into the market. So, okay, so for example, let's say I want to go long here and I'm going to be entering exactly where price is. I'm just clicking buy or sell on the market. You would normally select obviously your lot size and then you're just hitting buy or sell. That is a market execution. So I'll show you what that looks like. Now this is slightly different because it's on a replay tool, but when you're on any other platform, you will literally have the lots, the size of the trade you want to go in with, and then you'll have buy or sell. So I want to do a market execution. I'm only we'll talk about risk in a bit, and then you'll see, let me just delete this. So that is now my trade. This is where my entry is, and you'll see as I play forward, I'm now in that trade. I'm directly in that trade. The price moved against me. I wanted it to go up. So I'm now essentially losing money, and that's just how it works, right? So you will either hit your take profit or you'll hit your stop loss, or if you want, you can always close it early, which I wouldn't suggest. I would always suggest sticking to your plan. Whatever your stop is, whatever your take profit, always stick to that. All right, so let's close that. So the next type of execution is what is called a stop order. Now a stop order is where you're placing your trade, you're placing a pending order above price. So if price is moving up, you're placing it above, expecting price to pick you up on the way through. So you're not expecting any kind of, you're just expecting price to keep moving in the same direction. That's when you use a stop order. So let's say, for example, I think price is going to come up to here, and then from here we're going to pick it up as it breaks the high of this last candle. So that's what I'm looking at, and we're going to go in and we're going to change the type to a stop order. So we'll place that in, and as you can see, let me delete that. As you can see, there's my order. It hasn't triggered yet. I'm not in yet. It'll only pick me up once I move past there. So at the moment it's moving down. Okay, so we didn't actually move in that direction, so I can close it. And that's a cool thing about an order. If price doesn't do what you think it's going to do, you can actually close it and you're not risking getting into the trade. So let's do that again. So now let's actually go for a sell. We say, actually, we think price is going to come down to here. We'll place again another stop, save that, and then let me delete that and we'll quickly play this through. So there we go. You can see price picked me up, but it turned around. So now I'm in the trade. There's nothing I can do, and you just got to hope that it goes in your direction, which it doesn't, and it stops me out. So be it. So now let's talk about the next type of trade, which is a limit order. Now this is essentially if price is moving up, you will place your order below price, expecting there to be a retracement to pick you up, but then continue in the same direction. So you're expecting price to kind of come down to a certain area, or if you're selling, go up to an area before it actually opens your trade. So what will that look like? So let's say we're expecting price to come down to this area here, order block, whatever it is, and that's where we think price is going to turn around from. We're going to place, that's the wrong one, we want a buy. So you're going to have price there, and it's going to go into a buy once it picks that order up over there. So what is that going to look like? So we're going to select a limit order, not a stop. We want a limit order, and let's just delete this so you can see it clearly. So you can see there is my position. There's my order. It's waiting to be picked up. So let's see what that looks like. Okay, it's picked me up. Now we want it to turn around, which it doesn't. And you just got to play that through. If it stops you out, it stops you out. If not, then so be it. But you guys get the idea. So one way or the other, it's going to either hit your take profit or your stop. And that's basically, let me just close this, 100%. All right. So that's the three different types. You get market execution, which is entering directly into the market. You get a stop order, which is essentially price moving in the direction and you're just waiting for it to pick you up. And then you get a limit order, which is you're expecting price to retrace a bit, move in the opposite direction before it carries on moving in the same direction. So that's what we're looking at. And now the next and final step is risk management. So this is very important. This is where we take everything we've learned and we put it all into this one trade. So we know what a pip is. We know what a lot is. Now, how do you put that in together in an actual trade? So let's say we want to enter into an execution here. You've got to have an understanding where your stop is going to be, because you want to understand, because stop limit, wherever your stop is, that is dictating how much you're risking, right? So you always want to make sure you know what you're risking. If you want to risk 1% per trade, you've got to know how far your stop is to actually work out what your risk is going to be. So on this, it's obviously easy. If you're trading on different platforms, you can actually get calculators within the platform. Sometimes you've actually got to install them. For example, MT5, you can have a risk calculator, which will automatically calculate that because it's you don't want to be working it out, especially if you're entering market quickly. You want to quickly work out what it is. Another way you can do that is by just typing in lot size calculator. Now, there's a lot of different lot size calculators and they all do the same thing. I always use the one in baby pips. Very simple. So let's say, for example, we're on the Euro USD. Our account balance is $1,000. We only want to risk 1% of our account, but we know what the stop is. The stop is going to be a 15 pip stop. Now let's see how much that is. Now your position is going to be a standard lot. It's going to be 0.066. So you want to make sure that you're risking 0.66. So if we go to the chart, let's have a look what that looks like. So let's go to a sell. So let's say we want to enter this right here. And we said we want a 15 pip right over there, and doesn't matter what our stop is. Let's have a look. If we actually go place the order, look at the market execution, we want to risk 1%. There you can see pretty much exactly what I said, 0.06. I said 67, it was 67 something. So do 0.68. So 0.68 lots is exactly what I'm going to need to risk that 10%, right? So you can see as I change this, let me close this. You can't always risk the same. It's always dependent on your stop. If I have a much bigger stop, now if I still want to risk that same 1%, you can see now my lot size, my position size has changed. It's now 0.02. It's no longer 0.06. So you have to always understand how far your stop is. Your stop dictates how much of a size you're going to put onto that trade, right? So that's the first thing you need to understand. You need to understand how far your stop is, and then you can work out what you're risking, 1 or 2%, and based on that, it'll give you your lot size, okay? So very quickly, you go to a lot size calculator and you can work that out. Now, the next thing you need to know is what your risk reward ratio is going to be. What does that mean? So let's say, for example, this trade, I am risking 1%, right? I'm risking 1%, but in order for me to make 1%, I need to be doing a 1-to-1. So if I lose, I'm losing 1%. If I win, I'm making 1%. Now, generally speaking, I would say for a new trader, you want to be looking at least a 1 to 1.5. So what does that look like? So for every 1% you're risking, you want to be looking at a 1 to 1.5. So there you can see 1.5 over there. So that means if I actually win the trade, I'll be risking 1% for a $1,000 account. That's $10, but I will be making $15. So it means that you can actually have a win rate that is lower than 50% and still be profitable. So obviously the higher your risk reward ratio, the less your win rate needs to be. But you do have to understand that the higher your risk reward ratio is, the lower your win rate is going to be. And then it comes down to your tolerance, your risk tolerance, and how you can actually, are you able to handle multiple losses? Because let's say, for example, you're risking a 1 to 10. That means for every 1% that you are risking, you can make 10%. That essentially means that you can go 10 losses in a row, but that one win will wipe out all the losses, right? So you only need a very low win rate to actually be successful. So you've got to figure out what is the best for your strategy. Once you have a strategy, you've got to figure out what is the best risk reward ratio for you as a trader. What is your tolerance? How many losses are you willing to take? And then obviously you've got to back test that. And that's it, guys. That is all in very basic terms. That's all you need to know to be trading on the Forex market, right? You've got to basically understand your lots. You've got to understand what a pip is. You've got to understand the different types of trades, your market execution, your stop orders, your limit orders, and how that works into your strategy. And then you've got to figure out how to put that all together and build a trade around that to always make sure that you are risking the same amount. Because if you're always risking 1%, then you can actually start tracking your results. And once you start tracking your results, it'll be easier to then work on fixing a result, or it'll actually be easier to work on your strategy, get your strategy better, because you have all the numbers. The more clear your data is, the easier it becomes to actually fix or better your strategy, which ultimately will better your profitability, and it'll make you a much better trader, and it will get you to profitability quicker. So now that we've talked about that, we've shown you how to get into the market, how to trade. Let's look at some other factors that come into trading. Like, for example, the 3 biggest mistakes I see traders make. The first one is trading without a stop loss. This can definitely kill your account, because if you have no stop loss and it moves against you and it keeps moving against you, then you can very quickly blow an account and lose everything in your account. So it's very important to keep a stop loss. Make sure you always have a stop loss. And like we discussed, make sure you have the same risk per trade. The next one is using too much leverage with your broker. Now, a lot of brokers will advertise that they do 1 to 500 or even bigger leverages, which ultimately means that for a smaller account size, for a $100, $200 account, you can actually risk more. You can trade more because they kind of put more in for you, but that also means that you can lose more. So it's very risky as a new trader. You've got to have an understanding of what leverage is. So I would always suggest go in for a 1 to 50, a 1 to 100 type leverage when you're starting out. You don't want to be looking too much higher than that. And then the third biggest mistake that I see is over trading. You get new traders coming in, they have a couple wins, and then they feel like, okay, I've got this, I'm winning. And that kind of makes them feel like they want to do more, almost like gambling. When you win, to put some more money down because you want to make more, you get that greed factor and you want more and more and more. And this leads you to over trading, which ultimately losing and end up losing everything you make plus more. And then on the flip side, you get traders that lose, and then because they've lost, they want to revenge trade. They want to make back their loss. They'll keep entering the market, keep entering to try and make back their money. So don't overtrade, guys. Stick to a set number. If you have a number in mind, you say, I will not trade more than 3% per day of 1%. I can take 3 trades. If your risk reward ratio is 3 to 1, that means if you do win one of those, you will be making money back, or at worst, maybe breaking even for the day. So make sure you have that number in mind. And then the next thing we want to talk about is how you actually can re-chart and do your analysis on a chart. The 3 things I think a newer trader needs to look at is what type of strategy they're going to be looking at trading. Now, I would suggest either looking at trend trading, because they always say trend is your friend. So I would look at definitely starting with a trend-based strategy so that you can trade with the trend, whatever it is. There's a lot of strategies out there. You've just got to find one that works for you. And if you don't want to trade trend, then the other one would be a support and resistance strategy, because there's a lot of support and resistance strategies out there, and they are always fairly good. You've got to just get an understanding of where the support areas are, where the resistance areas are, because most of the time you will have price reacting from there. So those are the 2 I would suggest looking at and kind of studying up and learning how to trade support and resistance and trend. And then the final thing I think you've got to look at, you've got to to start studying up and you've got to get good at is candlestick patterns. Start studying up candlestick patterns, different patterns. And once you start getting an understanding of what these patterns look like, what they mean, you can throw that into your strategy, and it could definitely help with better entries and better exits. So try and make sure you're doing these three things when you're kind of analyzing charts. Now, the next thing you need to look at is obviously where to trade. Now, you've got to try and make sure you're selecting the correct broker. Now, when you are selecting a broker, I would always suggest making sure that you're picking regulated brokers, because sometimes you will get some shady brokers that say they are regulated by unknown regulators, and these are very shady and they can definitely scam you. So when you're picking your brokers, do your research, make sure you're picking a broker that is well regulated. This is very important. Then the other things to look at is the spreads. Make sure they have very good spreads and their commissions are good. And then also have a look at their executions. Generally, you can have a look at, things like Trustpilot reviews on different brokers and see, are these brokers good, and things like that. So just do your research before. There's a lot of very good brokers out there, but I'm not going to suggest, because that's not the point of this video. I'm giving you guys some tips and advice on this. And then the next thing you need to look at is obviously what platform you want to trade. So I would always suggest start with demo accounts, go to your broker, have a look at the different platforms they offer, set up a demo account on each of them, trade a little bit on each of them. You've got MT5, MT4, you've got C Trader. You can actually, some of the brokers allow you to trade directly onto TradingView, which is cool because then you can do your analysis as well as entering straight into the market. But if you are trading on MT4 and MT5, a lot of people will do the analysis on TradingView and then they'll enter on MT4 and MT5. And if you are using things like EAs and stuff, I would suggest MT4 and MT5. But you've got to figure this out. Start with a demo account, trade with a demo account on all the different platforms, and get a feeling of which platform works best for you. I would definitely say that the better platforms for a beginner are probably TradingView and MT5. So those are the ones I would suggest. But like I said, it's your call. Have a feel, have a play, see what it feels like for you, and then you can pick the best for you. Now, the final thing I want to talk about, guys, is capital. When you are figuring all of this out and you've got your strategy and you are, proving to yourself that you are profitable, you've got a strategy that works, you've found an edge, you've traded on a demo account, you are consistently proving that you have some profitability in the market, then what is next? You need to get capital, guys, because it doesn't matter. You can be the best trader in the world. If you have no capital, you cannot make money. And when it comes to Forex trading, you actually need a substantial amount of capital to actually make some good money. So with that being said, what is the best way to actually get capital? Well, I would say the best way to get hold of capital in this day and age is through prop firms. Now, prop firms are companies that will give you capital provided you can prove that you trade. And how they do this is they will put you through a 1-phase or a 2-phase challenge where you have a demo account, you trade on that, you have to get, maybe 10%, 5%, whatever the profit target is, and you will have set rules and set restrictions that you cannot go against, like you cannot go below 5% drawdown in a day, 10% total. And each prop firm will have their own rules, but essentially what that means is once you pass the challenge, you will get funded. So if you buy into a challenge that is for $100,000, if you pass that challenge, you will then get funded with $100,000 of capital, and that means that you can then start making money. And normally you'll make 80% of whatever profit you make. That's the norm. Some prop firms are different, but you'll be looking at an 80-20 split, which means if you make $10,000 profit on an account, you'll get $8,000 of that. And it's a great way to build up capital as a new trader, as a trader that doesn't have their own capital. This is a great way. It's much less risky because you're only putting in about $400 or $500, for example, to take a 100K challenge. Now, if you pass that, you could make that back within the first payout. Let's say you hit $2,000 on your first payout, you are making back that $500. And in most cases, you will also get that $500 paid back to you on your first payout. So essentially, once you've got to that point, you've not actually put any of your own money. Now, here at Blue Edge Financial, we specialize in prop firms, and we've actually got over 1,000 of our members, our community members, funded with prop firms and making money. So it's a great way for you to start making money before you actually, start trading for real. So while you're actually figuring it out, while you're figuring out what strategy you want to use, while you're trading on a demo, while you're figuring everything out, you can actually start making money, because what we do is we have an EA called TitanX that trades for you. You don't even need to know, you don't need to have a strategy. You just got to let Titan do everything for you. So it's a great way for you to actually start making money, start building your capital in time for you to actually start trading once you've figured all of this out and once you actually want to go to market. So while you're practicing on a demo, you can have Titan trading and actually making you real money. So if this is something that sounds interesting to you, make sure you go to www.propfarming.com. Have a look at the demo. It explains everything, how this all works, and then you can actually sign up and potentially be making capital for when you're ready to trade. Now, let's talk about the fastest way to kind of get going. Once you've figured all this out, you've learned all of this, what do you need to do? So the first thing you need to do, guys, is you need to find a strategy that works for you. Now, like I said, there's a lot of places you can get strategies. You go online, there's a lot of education. Pick a strategy. There's so many strategies out there. The strategies are not the problem. It's normally the trader. So find a strategy that works for you. Trade it on a demo account. Go and trade it for 2-3 months on a demo account. Like I said, figure out what platform you want to use. And then once you have traded that on a demo account and you can see you've got an edge and you can see that profitability happening, then what you could do is you could put a small amount of money into a live account, $100, $200, start trading that so it's real money, and that'll give you an idea of how you react to certain situations when it's actually real money on the line, because it's always easy to trade with demo because it's fake money, right? You're not actually losing real money, but then you can start putting in real money slowly. Don't go big, put in a little bit, see how you react, see how you are trading on, you know, a live account with real money, and then you can slowly start upgrading from there. And then the final thing I would say is it's very important to track everything you do, guys. Make sure you're journaling everything, because you can learn as much from your losses, because you can learn from your wins and your losses. So every time you take a win, you understand why you won. Every time you take a loss, you understand why you lost. And you can understand so much about your strategy by journaling it all, looking back and just taking that data. Data is so important, guys. So that's it, guys. That is a brief kind of introduction to what Forex is. And I hope this gave you enough to kind of start you off and get you going on your trading journey. And please make sure, guys, if you did like this video, to like it, because it definitely helps us out. And if you haven't already, subscribe, because we're going to bring you a lot more. And we also do a lot of prop firm reviews in this video. So we were talking about prop firms, and if you are not sure what prop firm to go with, then this is the channel for you, because we do a lot of prop firm reviews. You can have a look, and that can help you choose the best prop firm for you. So with that being said, guys, I hope this video was helpful. I hope it gave you enough information to kind of get you going and get you studying and get you learning and get you into the Forex world. And with that being said, guys, I'm going to leave you there. I wish you all the best in your trading. And remember, play it safe. Make sure you're managing your risk, and you will be all right. So with that being said, guys, we'll see you in the next video. Bye for now.